$700 an ounce silver. I'm not saying that's going to happen, but I mean, is it the craziest thing to think of? If you take 34 or 3640 divided by 7, which is the geologic ratio, it's actually 520, so let's get a little bit more realistic. But $520 would represent the current geologic ratio. But what happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher.
In today's news recap, will silver's explosive rally drive prices to $50 this month? Silver climbed within striking distance of $42 an ounce on Monday, posting its strongest rally since 2011 as a deteriorating U.S. labor market reinforced expectations of a September Fed rate cut. The highly anticipated non-farm payrolls data confirmed a sharp slowdown in job creation, with unemployment rising to the highest level since 2021. Analysts at GSC Commodity Intelligence are now pricing in near 100% odds of a 25 basis point cut on September 17th. The possibility of a shock 50 basis point jumbo rate cut has also emerged, a move that could send precious metal prices into the stratosphere. Silver has already surged plus 47% year to date, more than doubling in value over the last 3 years. The momentum is unmistakably bullish. Data tracked by GSC Commodity Intelligence shows a steady rise in speculative longs, while flows into physical silver and ETFs continue to accelerate. Wall Street desks are openly discussing the possibility of $50 an ounce by year end if institutional allocation expands further. Every indicator we track is flashing green, says GSC Commodity Intelligence. Institutional positioning, ETF inflows, and physical demand are all converging to create what we believe is the most powerful setup for silver in more than a decade. Silver is not alone. Gold has already surged plus 35% in 2025, hitting a new all-time record high of $3,646 an ounce. Analysts at Goldman Sachs now forecast a run toward $5,000 an ounce. That's a plus 40% gain from current levels. For context, 1 ounce of gold was just $35 in 1971 when Nixon closed the gold window. Today's price represents a 103-fold increase over 5 decades. The verdict from GSC Commodity Intelligence is emphatic. Those who position now will capture what could be the most profitable super cycle of our generation. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
You're seeing the numbers in all of vaults, except the LBMA, which is going the opposite direction. But yeah, you're seeing massive, we're seeing really large orders even in the retail side. We're just not seeing the huge volume. But 7-figure orders are no longer the exception at all. But yeah, you look at the COMEX numbers, there's a massive amount of hoarding. You look at the amount going into the world's ETFs, it's huge. So I hate that part of it, SLV, which is really a tool for manipulation because of the naked shorting. I would much rather see the money go into physical and drain. When you look at like Saudi Arabia, who took this huge position in SLV, the one saving grace is the position is large enough to where they can demand delivery. And it's like when the Texas Teachers Union, which was being run by Kyle Bass years ago, put $1 billion into gold. He took possession out of GLD. So, but just simply at face value, yes, that is true. The ETFs and many of the Western exchanges are seeing record inflow, not all of it leaving. And the numbers, the eligible numbers, are going much higher. But there is some leaving, certainly. But you're right. It is very obvious that there is a huge amount of hoarding. This will promote, very possibly, that short squeeze that everyone's been waiting for, because there's just not enough in the way of those size good delivery bars in the West to really to protect. In fact, even BlackRock wrote in the prospectus of SLV that be careful if you're short, because there could come a time when there isn't enough silver to cover those positions, and it's a big threat. Now you're talking a squeeze and the price goes up parabolically and bankrupts people. So ultimately, that would be where I think this is hedging or heading to. The first step would be taking huge positions and hoarding it, not selling it at prices anywhere near where we are now, because, just taking where we are right now, if you look at gold right now at 3640, call it, and if we divide 3640 even by 70, which is way higher, that's $52 right now. It should be massively higher than it is right now. And if you did it by the average, even call it 40 to 1, where it's been about 45 to 1 for the last 100 years on average, you're looking at $91 an ounce silver. Is that out of line? No. And at 45 to 1, it's still 7 times higher than it's coming out of the ground at. So, 91 times 7, in theory, $700 an ounce silver. I'm not saying that's going to happen, but I mean, is it the craziest thing to think of? If you take 34 or 3640 divided by 7, which is the geologic ratio, it's actually 520. So let's get a little bit more realistic. But $520 would represent the current geologic ratio. But what happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher. The old bag of tricks would be you put it into treasuries earning a fair rate of return and let the laws of compounding be your friend. Back in the day with 9% interest every 8 years, your principal would double. And, if you had 9% interest and millions of dollars, that's fine. Double every 8 years. The law of 70 seconds, 9 into 72 is 8. Problem is that where we are right now, the inflation is far higher than the rate of return. And so a real negative rate of return makes bonds a no-starter. I mean, it's a no-go. And so then what? Do you put your money into an equity market where valuations are higher than at any time, even the 1929 crash of the stock market, anytime ever, at a period of time when you have the largest ever margin debt by the retail public, the largest ever exposure to options by the public, and the largest ever participation in the stock market by the public, as the insiders are literally moving the other direction. You put it into real estate when 30 years worth of suppressed interest rates have created great distortions. And where do you put it? I guess, municipal bonds, but aren't the municipals or the municipalities in trouble too?
Silver price news targets $41, $47, and $66 as Fed liquidity sparks bullish momentum. The precious metals market is buzzing with excitement as silver emerges from a prolonged consolidation phase. After months of sideways trading, technical indicators are aligning with macroeconomic tailwinds to create what many analysts are calling a perfect storm for silver bulls. With the Federal Reserve potentially shifting gears and inflation concerns mounting, investors are eyeing silver as both a hedge and a growth opportunity. First target, $41. This breaks silver out of its current range and confirms the bulls are in control. It's not just a number, it's a statement that the consolidation phase is officially over. Second target, $47.6. Here's where things get exciting. This Fibonacci extension level represents serious momentum territory. A push to these levels would grab headlines and pull in momentum traders. Third target, $66. Now we're talking about a completely different silver market. This long-term projection would represent a fundamental repricing of the metal, putting it in rarefied air not seen in over a decade. Dream scenario for metals investors. Everything's lining up for what precious metals enthusiasts have been waiting for. Fed policy pivot, check sticky inflation, check economic uncertainty, check it's like a checklist for precious metals outperformance. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
DeSantis down here in Florida, who's trying to get rid of property tax. But you're right. And so all of those distortions that are created through suppression of interest rates, there's always consequences, some intended, some unintended, that happen through messing with Mother Nature. And you're right. The house values have come down because no one wants to move based upon the value of, or the rate that they're locked in at. And Trump talks about lowering rates to make new houses more affordable, but really it would be higher rates that would make them more affordable, not lower rates. Yes, you can take out more debt with lower rates, but higher rates would find that equilibrium finally between interest rates and assets. In a low interest rate environment, assets really go to the moon. And so by lowering rates and devaluing the dollar, again, you're just benefiting the 1% whose assets will continue to march higher in that environment. These are very, very crazy times. So where do you put your money? Because of the suppression in interest rates and the distortion of asset prices for all of these years, asset prices, to invest into assets right now at all-time highs, you have to wonder, do they continue to go higher? I just happen to believe that there are very few places that offer the kind of appeal right now, not always, but right now that gold and silver do. And I think you are seeing sophisticated investors wake up to that. Again, who the hell is taking possession of billions of dollars worth of gold and silver every single month? Now, when I say possession can be held in your personal storage account unencumbered in a COMEX vault, sure, or it can be taken off the COMEX. Both are happening, but big money nonetheless. This is money that is not just big; it's sophisticated, it's well informed. I think that's kind of the key. But when you see this, not only the front running by the central banks, whoever's doing it here in the United States, when you see the absolute certainty that you're going to see a devalued dollar and lower interest rates, which will, what's that going to do to the back end of the market? Are there ramifications in the banks? All these things are connected. And when you take a step back, the only place that I would put my money where most of these things, if they play out negatively, I think gold is a benefactor, silver too. But I think you don't buy to become wealthy. You buy because it is wealth, and the biggest money in the world is showing you there are very few places safely to put your money other than gold and silver. So that would be my choice. Forget about the fact that I own a company that does it. I'm trying to be completely objective. I don't know, man. Where do you want to put it? If I give you a $100 million bill right now, where are you going to put it? You're going to put it in ultra short treasuries? Maybe. You're going backwards. You're going to put it in real estate? Maybe a little bit, but at all-time high valuations. Stocks, all-time high valuations when the insiders are leaving. I don't know. The choices are fewer and further between. How about gold and silver, which have no counterparty liability, that have outperformed everything, that the biggest money in the world is copiously buying, and many are securing their own. So central banks, commercial banks, very large institutions, and sophisticated investors. So take your pick. Trust me, or listen to what I have to say, or don't. I mean, I spend a lot of time trying to figure it out, and I'm speaking not to you, I'm speaking to everyone out there. I mean, I don't know. I don't know where else to put it, and I think hard about it. I mean, you can put little bits here and there, but the trade-off between risk and reward in so many places right now in all of this unknown monetary, soup. I think there are a lot of things that just aren't worth the risk right now. If you look at the amount of deposits held in banks, it's falling, which tells me the wealthy people don't keep their money in cash. They don't. And that's why they're wealthy. This is specifically why the wealthy people own assets. Because what has happened in the last 8 months? Gold's up 40%, the dollar's down 11%. Look at the value of the dollar since you were a kid. I talk about this, I've mentioned many times probably on your show. When my parents got married in 1963, my dad said he could live, he and my mom, on $6,000 a year, easy. And after a while, after saying that, I'm like, this can't be true. I just looked it up the other day. What is the average salary in 1963 in the United States? It was 10 grand. So, he was just first year out of college. That's fair. And you could live comfortably, 2 people. I mean, how many people can live a month right now on 6 grand, or a week these days? It seems, it's, I just think that the value of the dollar is dying, and it's starting to become exponential. So keeping your money in dollars is the worst thing to do.
What do you think of Andy's take? Do you agree with him? Will gold reach $4,000 by the end of the year? Is there any top? Post in the comments section down below your gold and silver price targets for the end of the year, and hype the video if you liked it. Now, watch this video right here because it's a perfect fit for you, and I'll see you stacking on the other side.